Good morning, traders and investors. Roger Scott here, senior strategist for the Trading Pub. It's Friday, it's November 13th, and it's about 7:43 in the morning. The market's not going to gear up to open up for about an hour and 47 minutes, if my math still serves me correct. And the message for today is, money never sleeps. You should see me sometimes. I dream about the markets all night long, about trades I'm in. It's amazing. Anyhow, looking at the futures, we're looking pretty good, and we actually bounced pretty good yesterday as well. Dow's up 94 points. Nasdaq is up only 6. Definitely not leading today. Clearly, we could see that blue chips are outperforming the tech stocks today, even though this is random. Now, before we get too excited, you've got housing starts and permits, and you have a whole bunch of Fed speakers. Now, typically, housing starts is not a massive report, but remember something happened this week. If you look at the bond market, you will see, actually, let me show you what happened. It's easier to show you via the stock market. Remember, we had the CPI report, and the CPI is now telling us that, well, the CPI is now pointing to Fed peaking at its rate hike. And if interest rates aren't going to go higher anymore, there's a natural inclination to think they're going to go lower. They're not. Don't get so excited. But this causes real estate sensitive stocks or interest rate sensitive stocks, which are real estate. Real estate is very interest rate sensitive, to start moving aggressively. And if you look at XLRE, you will see last few days, they've moved up pretty good. Look at that. That's after the CPI came out. So today's going to be a really, really important report because these stocks are hot right now. And if this number is going to be good, because partly because things are moving in the right direction, and remember, markets discount, it can cause a nice juicy rally in real estate related stocks. So again, anything that's very sensitive to interest rates, like real estate, consumer staples, those stocks are very, very, very sensitive right now. But housing starts could be a big, big report. So just want to make sure you keep your eye on the home builders and the real estate sector as a whole. Very, very important today. The key levels there right now are actually right here, the 200-day. If it bypasses 3750, we're good. Now, looking at the market as a whole, let's just start with the S&P, and then I'll get into global economy. Oops. You can see right here, we're actually doing pretty damn good. Let me just look. It looks like we're building a base. Doesn't look like we're going down. I was very much afraid after the report came out, after this big gap, that we were going to start coming down. But we've been holding up pretty darn well. And right now, we're actually trading above that swing high, or right at the high. Let's see, the high here was 451.38, and the high here is 451.66. So we're already trading above the previous day's high after the CPI. That's very positive. The question is, are we going to come down or are we going to bolt higher? Right now, the way I see it, we're probably going to be consolidating and figuring out what the market's going to do. And then after the reports come out, and you could see the reports come out about 9:45, all the major reports, and then you got Susan Collins speaking. So I would imagine by 10:15, the market will set its tone. Do not trade the first half hour or 45 minutes today. That would be a big, big mistake. Now, again, looking at the SPY, just to give you some perspective, if you go far out enough here, you could see that there's a major resistance level, right here at 454.33. Well, we're only at, right now we're only at 451, and that's pre-open. So we got a little whiles to get there, but keep an eye on that level. On the there's nothing before that though. On the QQQ, you are literally, look at this. We are on the QQQ at the high. So there is clearly a clear bias to the upside of the market. You don't want to sell this, and look at how it's been sticking to this resistance level. So if we can break above here, we got clear blue skies, and that's very, very impressive. And that's one of the reasons why over the last week, semiconductors, real estate, home builders, interest rate. See that? XLRE, XHB. That's the one you also want to keep an eye on. Let me just go there real quick. XHB. XLRE is the bigger one. The smaller one is specifically home builders. But you could see how sticky they've been here. And there really isn't big support till 84.61. So we can bolt. Keep an eye on that sector today, especially at near the opening bell. Looking at the small caps, and small caps are also very interest rate sensitive. They're still struggling. They bounced off of the 200-day moving average, and they're still rather bearish. Now, we're between the 200 and the 100-day, and typically in a bull market, we have small caps leading, but everything has been completely screwy. My point here is be careful. Be careful till we cross 182 and stay there. Until we're above the 200-day moving average, small caps are just not in play right now. I need to see strong bulls. We're not out of this yet. We're getting out of this, but we're not out of this just yet. Now, let's talk a little bit about global economy. I'll tie everything together for you, and then I want to talk about the bond market a little bit. So U.S. Treasuries continue to fall after this weak soft U.S. inflation and job data spurred expectations amongst investors that interest rates have peaked. And by the way, I forgot to mention, please subscribe to my YouTube channel and Telegram channel. Everything you need is below the video on YouTube. And like us and subscribe. Labor market. The labor market yesterday, 231 adjusted. Still nothing really all that crazy. I don't think that was a big factor. Manufacturing activity was stronger than expected. Industrial production fell a little bit. But here's where we get to the good stuff. Mester stated Thursday that she has not yet determined if another interest rate hike is necessary, emphasizing that officials have the time to observe how the economy evolves. And we're at a more balanced place, but I don't think we can stay right now what necessarily the next policy meeting will be. I'm going to tell you something right now. I am actually not critical of the Fed anymore. You know why? They haven't been full of you-know-what for the last 3-4 months. They've actually been being completely honest. It's not what people want to hear, but they've been honest. They stopped playing the whole, we did the right thing by not raising rates while economy was falling apart. That's all in the past. They're basically saying here, we don't know. We're moving in the right direction, and we are. We just don't know. We don't know. And that's an honest answer versus making up some cockamamie excuses and saying stupid stuff. They simply don't know. But honestly, I think we're going to have one or two more probably around February, March of next year, if I had to guess. They want to see how the market's going to do. They've been very aggressive. They typically want to wait. It makes perfect sense. We're now pricing in a 34% chance of a rate cut in March. Now, that's amazing. So if we don't get a rate cut in March, it's going to be very bad for the bond market because the bond market and the economists are now predicting two different things. And that's scary. But I'll talk about the bond market, but I'll talk about this 34% and I'll tell you where this is coming from. Biden signed a stopgap spending bill to prevent government shutdown. U.S. building permits are coming out at 8:30 in about 39 minutes. Chicago Fed Goolsbee, Collins, and Dolly are going to be speaking today, but fortunately it's all happening in the morning. The last one I think is at 10:15 Eastern. Europe is doing good. They're getting some tailwind from interest rate cuts in the U.S. Gains in real estate and healthcare stocks are leading the overall market higher. Now, here's the problem. Healthcare stocks are not interest rate sensitive. Real estate is. Healthcare, really, it's not. So that's kind of interesting. China closed higher. Bloomberg reported that China's central bank told several nationwide lenders to cap interest rates, highlighting regulators' effort to stabilize financial markets. Good luck with that. Nikkei bounced higher, making its third consecutive winning week, supported by a robust domestic earnings season that concluded. Utilities, healthcare, and basic materials led higher. Interesting, because utilities and healthcare are defensive. Basic materials are not. So it's really interesting. It looks like they're having a broad market rally. As far as data, Gap is up 18%. Expedia is up over 3%. Now, I don't know if you guys are watching my Telegram channel, but I remember either yesterday or the day before telling you that Expedia looks like a really hot stock. No major earnings today. You've got BJ Wholesales Club, but we're pretty much done with retail, and they have been mixed. Now, looking at the bond market, right here, this is what I was talking about. You see this ascending triangle, and you see how we're breaking up right now? Remember what I said 2 days ago, if we break higher, it's positive for the market. If we break below this red line right here, not in the between, below this red line here, it's going to be bearish for the market. I'm going to leave this here for a while, but notice we're breaking above and the market is rallying. The market is very, very, very bullish today. It has a good sentiment. Remember what I told you earlier in the month. November, December has positive seasonality for the stock market. You only want to be short the weakest stocks possible. Like, for example, we're short this stock right here. I mean, that's a pretty weak stock. I'm expecting it to break down. But otherwise, you don't really want to be short in this market. You want to be bullish in this market. Now, as far as sectors are concerned, keep your eye on the home builders. Speculative sectors, interest rate sensitive sectors are right now keying off big time. So you've got home builders, semiconductors, real estate, Russell 2000, which isn't really doing all that great, basic materials, technology, consumer discretionary. Finally, this is starting to look kosher. Communication services is down here, and invest in QQQ is down here because of communication, because this is a third of the QQQ. But I'll take it. Blue chips, spec blue chips. It's as clear as day. Speculative stocks want to rally right now. Consumer staples, boring stocks don't. We know that because we're holding this stock long here. Dollar General. Oh, excuse me. Not GDDG. I had it backwards. Morning dyslexia. And you could see here, it's still in a good trend, but we got in right here and we're holding on. It's still sitting right below the 8 or right at the 8-day MA, but we're going to have to be careful. We may get stopped out of this position. Another position that we're long right now is Shopify. And I like Shopify. I like this trend right now. I like what I'm seeing. Now, before I let you go, and by the way, please subscribe to my Telegram channel. If you don't know how to, go to rogerscott.com/Telegram. All the instructions are there. It's really easy. You just put in your phone number, you get an alert, you set it up, you get a confirmation, you press a button, and you're in. It takes about 30 seconds. I now set it up on all of my computers. It's really convenient. You could do it on a laptop, your phone, anything. rogerscott.com/Telegram. If you want to get these videos the minute they're released, go to YouTube and go to Roger-Scott, and you'll see my channel. Subscribe and hit the bell, and you'll get notified when they come out, which is pretty cool, right? And as far as getting a hold of me, you could always send me an email at roger@rogerscott.com. And remember, markets never sleep. Have a great weekend. If you have a question, I'm always around, roger@rogerscott.com. I will respond to you. You're not bothering me. It's all good. I'll see you guys later. Have a great weekend, and let's make some money. Bye. Hey, folks, you know what? Dividend stocks may not be the most exciting trades, but they're steadfast, dependable route to pocket extra income from the stock market, right? Let's be clear here. You can't just blindly scoop up that dividend stocks or any stocks that pay dividends because the yield may be paltry or the quality of the stock may be bad. What's the use of dividend if the stock's dragging your portfolio down, right? You want something to help you, lift you, not drag you down. So what's the smart move here? Well, you can grab a straightforward, easy blueprint right at the link below this video. Stick it to it like glue before you even think about diving in. Celeste and Jack will deliver the cream of the crop in high-yield dividend stocks to you on a silver platter, stocks you can snap up right now and start seeing extra income. Remember, money never sleeps. I'll see you guys later. Bye.